Welcome to Make Your Money Matter. I'm your host, Brad Barrett. I'm also a managing director and partner here at One Capital Management. Today, friends, on the show, we're going to talk about 3 ways to defer or avoid capital gains tax using real estate. Now, likely many of you have watched or have listened to our previous episode on some of the asset classes and types of accounts and how they are taxed. We also went into what specifically capital gains taxes are, and we had a few questions come specifically around real estate. So I wanted to frame a show here and help you understand 3 specific ways you can use real estate to defer or avoid capital gains tax. Like all of these episodes, when it comes to taxes, you want to make sure you speak with your tax preparer about your specific situation. But before we get started, make sure you smash the subscribe button, click the notification bell so you don't miss a single episode. All right, let's get into it. Okay, number 1. Let's talk about something called 1031 exchanges. Many of you might have heard of this, but those of you who haven't, what is it? A 1031 exchange is a code in the IRC code that allows investors to sell property and quote unquote roll the gains into a new property. Now, this allows a deferral on capital gains taxes, so real estate investors can actually acquire new properties and dispose of old ones while also deferring the taxes that are owed. Now, there's some caveats I should say about 1031s for a second. First, you must identify a property, a replacement property, within 45 days and close on that property within 180 days. You must also use a qualified intermediary. That's important to note there. And then lastly, your basis in your old property will also roll over to your new property. This, by the way, limits, I should say this, your depreciation deduction. So something to talk about with your tax preparer. Number 2 is this. I want to bring up as the primary residence exclusion. I talked about this a little bit on the capital gains show, so you can refer back to that, but I want to go more in depth on it here. A taxpayer, any one of us, can sell our main home and exclude either $250,000 or $500,000 if you're married in capital gains. Now, here's the rule with this. You must use the home as a primary residence for 2 years out of the last 5-year span. So you can actually rent, if you look at the numbers, you can rent for 3 years and live in it for only 2 years and you would still qualify. Number 3 is step up. So likely you've heard of this term before, step up in basis. Typically I bring this up with clients as it relates to maybe inheritance. So an inherited property receives a step up in basis once it is passed along to the heirs. This, by the way, allows the receiving taxpayer, those who inherited it, to either sell the property at a minimal gain or have a higher basis for future depreciation purposes. The step up in basis, I think, is one of the main components of the buy, borrow, die scenario. You might have heard this before. It's very simple. It's like basically the assumption that, or the planning strategy of buy something, borrow on that asset, and then pass away, because when you pass that on, it becomes somewhat efficient to those that are inheriting it. Again, I'm not saying this is right or wrong, but the 2 asset classes that I've seen be the best to pass on to your heirs when we talk about legacy planning is real estate, and which I just mentioned, and actually life insurance, because the step up in basis in real estate is great. And typically in life insurance, as I mentioned on our last show, you get the benefits of that tax-free. And this has largely been something that I've seen the wealthy, the high net worth individuals use as legacy assets to pass down to their heirs tax-free or tax efficiently. So those are the 3 ways you can defer capital gains taxes. I hope you enjoyed that. If you did, make sure to subscribe to our show so you don't miss a single episode. And always remember to make your money matter.